Hey guys, it's Sasha. Palantir just reported their Q1 earnings and the results were not good. The presentation of the results was even worse than the results, and the share price has taken a massive beating, dropping 20% down to $7.50 as I'm recording this video after the disaster that was the earnings call. In this video, I'm going to tell you what happened in those earnings by Palantir, explain some of the details, some of the in-depth analysis that I think is really quite important. Just so you're aware, I'm a Palantir shareholder and I hold a long position in my portfolio, but as with all analysis on my channel, I will say things as I see them. So unfortunately, you ain't going to get a sugar-coated version of the earnings call here. If you do want a rose-tinted version where everything is going to the moon and everything is dandy, please feel free to go and watch any of the other people covering these earnings. Now, all right, let's quickly look at the high-level data. On the surface, it kind of looks okay, kind of looks good. Revenue grew 31% in Q1, that is ahead of their guidance and their long-term target of 30% growth per year. US commercial revenue for Palantir grew by 136% year-on-year in Q1, an exceptionally high number, but it was not all dandy. I'm going to come to that in just a second. Palantir's operating costs continued to decline as a function of revenue. In Q1, Palantir lost $39 million from operations, which is an 8.8% negative operating margin. And the good news is that on a GAAP basis, that number is getting better and better every quarter. And there is a graph in the slides that show how it is heading towards the break-even point. However, there are several major problems that are brewing under the bonnet. First, the non-GAAP numbers are actually falling. It is relatively easy for Palantir to show healthy non-GAAP numbers when stock-based compensation is a really huge part of your overall cost base, of your overall expenditure. You go and take out all of that stock-based compensation out of the numbers, and hey presto, it looks like you've made a huge amount of money on a non-GAAP basis. But as those stock-based compensation numbers decline and they convert into other ways of compensating your staff or getting the right people through the door, you can see here that the non-GAAP margin is now beginning to drop and has dropped to 26% in Q1. Well, actually, you can't see it because Palantir chose to remove the graph that they used to have in the last set of updates. They now only show you the improvements of the non-GAAP data, but do not show you that the GAAP version is currently dropping. And this is a really important point that I'm going to make about this set of results. I will keep coming back to it over and over, and I am sorry about this, but it's really crucial. The presentation of data in here is, in my opinion, somewhat disingenuous. The whole presentation, especially the answers to pre-prepared questions, really came across as one slimy used car salesman pitch. And that really did not come across well for me, and based on the share price movement today, I'm guessing I wasn't the only one. The slides have been adjusted from the format that they have been using recently to avoid showing anything negative. They have deleted slides, several graphs, and moved some of them to the appendix to avoid showing negative information. For example, here is a slide that is really crucial because it is trying to tell a story about how Palantir is actually growing really well. It shows that the commercial customer count has grown from 147 clients last quarter to 184 this quarter. And next to it, they show that the average revenue per 20 top customers has grown up by 24%. And the problem is that these two graphs, the graph on the left and the graph on the right, are not showing you the same data. The graph on the left is showing you the growth in commercial customer numbers. The graph on the right is showing you the average revenue of the top 20 total customers. Palantir's biggest clients are government organizations and the military, not commercial clients. So if you quickly look at these charts, it sure looks great. Customer numbers are growing and the revenue per customer is also growing. Really great, because when you multiply them together, it looks really awesome for the next few years, except the customer numbers that are growing are not the same customers as the ones whose revenue is growing according to the chart next to it. Scroll up and you can see above that Palantir added 40 net new clients in Q1. That is a great number, by the way, much higher than the 10 they added in Q1 last year, much higher than any of the recent quarters. So massive thumbs up on that one. That's a very good sign. But then scroll down and you can see that 37 of those 40 new clients were commercial customers. So the government side of the business only net grew by 3, from 90 to 93 customers. So it's good in a way that those big government contracts are earning more per customer. But there is also a potential argument that the government side of the business is slowing down overall, because if you scroll down to the appendix, you can see that the government growth has stunted recently. It was only 16% growth in Q1 this year. substantially below the overall 30% growth target. So the issue we have is that the government business growth is slowing down rapidly, but the commercial side of the business is not picking up fast enough to take over, to pick up the mantle. The guidance for Q2 said that they're expecting $470 million in revenue, and that is only a 25% increase on the same quarter last year. So that is a big problem. The rate of growth is already dipping below their long-term 30% target, and there is a very, very big lack of acknowledgement of that fact or any explanation of how they are working to solve it. And the thing is, solving for that growth today should be far easier than in 5 years' time, because growing by 30% of a lower number should be easier than growing of a much larger number in the future. The adjusted operating margin in Q2 is forecast to be 20%. Remember, this is the number that was 26% of this quarter, and before this quarter, it was over 30%. Now, you wouldn't actually know that because this quarter they stopped publishing the chart that showed the adjusting operating margin over time. Because if you add on the 26% this quarter and the 20% next quarter to the chart that they used to publish, it would look pretty sad. And the thing is, there is probably a good reason why the drop is so substantial. But that reason was not provided in the paperwork. They haven't explained it. They haven't covered it. They didn't explain it on the call either. And nobody asked the question. So here is why it's really important. If we look back at the chart that shows GAAP and non-GAAP operating margins, before the last 2 quarters, it kind of looked like GAAP margin is sitting nice and flat at 30%, and eventually, as Palantir grows and matures, that non-GAAP line will go and meet the GAAP line. And we're going to be seeing this really solid business, maybe making several $1 billion a quarter, at some point in the distant future, with 30, maybe 35% gross margins on a GAAP basis, net margins, and that is going to look extremely good. But now we are seeing the GAAP margins drop. They've dropped to 26% this quarter, 20% according to them next quarter. So the fear here as a shareholder is that when the two lines do meet, they're going to meet much closer to zero than at that 30% mark. And investing in a software as a service business where typically net margins are reasonably high, with maybe just single-digit operating margins, doesn't sound massively appealing. They clearly thought that people might pick up on this point, so there is a bullet point in the guidance that says adjusted operating margin for 2022 will be 27%. The problem is that it doesn't say why or how it will be 27%, given that it is now lower than 27% and it will be dipping further down to 20% next quarter. The sort of good thing, though, on the counter is that 3 months ago, when Palantir was giving the guidance for the next year, they also gave an adjusted margin of 27% for the whole year, and their operating margin for this first quarter was just 23%. So in a way, they're kind of doing what they said, maybe slightly better, but then I'm not seeing anything in the plan, any kind of reasonable explanation other than just a load of very generic mumbo-jumbo as to why those margins are going to pick up in Q2, what exactly is going to change, and how they're going to go and improve the business to try to hit profitability. Now, there is one potentially very positive piece of news in here that is really, really important to cover. The total number of customers that grew, remember, by 37 new commercial customers is really big. It is a 25% increase quarter on quarter. And if you look at the revenue graphs by cohort from the last annual report, you can see that the commercial revenue tends to deliver very little in the first year of having a customer on board. The customers booked in 2018 only earned $7 million during 2018. They then earned $10 million in 2019, $15 million in 2020, and $17 million in 2021. The customers booked in 2019 only earned $19 million in 2019. They then earned $102 million just 2 years later in 2021, more than 5 times as much. So you can see that commercial customers have this tendency of being brought on board that generally don't really make very much money during the first year. It takes time to onboard, migrate, set up, etc., etc., etc. Whatever it is, it takes time. So the benefit of all of those new customers coming through will not be seen today. You'll be seen potentially in the next 2 to 3 years when we're seeing the revenue from them come through. The difficulty is in knowing whether those new customers are the same profile as the customers in the older cohorts. Now, are they the same size? Are they potentially going to generate the same sort of revenue? Or have we collected the low-hanging fruit early on? Have we picked off the big, easy customers, which are making a lot of money? And are we now going for the smaller clients? Because having 4 times as many customers is great if those new customers are roughly the same kind of customer. But if those new customers are, say, 10 times smaller, for example, it doesn't matter if you have 4 times as many, the net growth is going to be negative. Now, there wasn't any information either way on the mix of these new customers, so I don't know. It is possible that this is very, very good news, so we'll have to wait on the data to come through. But the warning flag for me is a few slides further down, because here it says that Palantir ended Q1 with $3.5 billion in total remaining deal value. Now, it looks good because it is up 26% year on year, but here is the thing. Last quarter, they didn't even publish that number in the slides. And the quarter before that, in Q3 2021, 6 months ago, that number was $3.6 billion. So the outstanding deal value has dropped in the last 2 quarters despite all of these new customers come in. So there is an indicator that the new customers coming in are perhaps not of the same value and not signing up to the same kind of deals as the ones that they already have. That number is the sum of the signed contracts, signed agreements that the company, that Palantir, expects to collect in the future but haven't collected yet. So the indicator here is that the sum of the outstanding contracts is shrinking rather than growing, despite the total customer base growing in absolute numbers. And that is a really negative sign. It is possible that new customers and new deals are not done on as long a basis as before, and that might be the mitigating factor. Maybe, they used to sell contracts that were longer, and now they're selling more money per year, but over shorter time frames, and that could be the sort of reason why these numbers look the way they are. They used to show charts, by the way, of how this remaining deal value is split between commercial and government and a whole load of information, and what the average number of years on those deals is. But they don't show any of that data in this report. Again, obscuring the level of information that we as shareholders have in order to be able to make a determination on how well the business is doing. And I really don't like that. The obvious question that comes up is why? If the average length of contracts is coming down, and that explains why the total outstanding deal value is staying flat, and that is actually a positive thing, then it would probably be a good idea to show it, right? If you were the company, you'd probably go and print that number to explain, hey, look, the total number is staying flat, but it's because the average deal length is shortening, and as a result, we're still going to be making more money per year. But if you're not showing the number while the number of outstanding dollars that you're yet to collect is dropping, it begs the really obvious question. Now, in the guidance, there was one very curious sentence. After saying they are targeting $470 million in revenue in Q2, they also say there is a wide range of potential upside to our guidance, including those driven by our role in responding to developing geopolitical events. So they are saying in a roundabout way that they think the revenue might jump up as countries like the US, UK, and Germany increase spending on military intelligence because of the war in Ukraine. That's kind of what it says between the lines. But there are other potential upsides other than this as well, according to the sentence. And the obvious question was, well, what are these potential upsides? Can somebody explain? That question was so obvious, and I highlighted it when I was doing the live coverage of the report, that it was asked not once, but twice consecutively in the live questions at the end of the earnings call. And Palantir completely flat out dodged the question and refused to answer it. They talked about something completely irrelevant. They even said that Q2 revenue is even hard to forecast because, well, we have to wait for the numbers to come through. There's a lot of uncertainty for a company that deals with data, that deals with analytics and forecasting and, industry-leading analytical capability. That seems somewhat hard to agree with, given that we are, halfway through Q2 already. So that answer just didn't smell good to me, and they then relatively abruptly ended the Q&A session after refusing to answer those questions. Perhaps the worst bit, though, for me was the constant reference to a potential nuclear war, a potential world war, the biggest war in Europe since World War II. All of that stuff just kept hammering on and on throughout the presentation. And then afterwards, Alex Karp published a letter just before going live where he goes on and on about it again. So the sort of context as I'm reading it based on this stuff that they were saying is, hey guys, there is a huge threat of a disastrous war, the worst war imaginable. Lots of people are going to die, but we're guessing that because we provide the software that helps governments in a time of war when they need to make important military decisions, that we are going to collect a huge load of money from this, and this is a great thing. We're not sure exactly how or when, but this is what we've been waiting for 20 years. This is great news. By the way, not my words. This is literally how Alex Karp ends his shareholder letter. But earlier on in the letter, in between taking talking a lot about how the war is great for business, he takes this amazing opportunity to go and insult his customers. He says, our most recent efforts to expand our sales team continues both in the United States and around the world. That bit is good. But then he says, but the tension persists between a customer's understanding of their needs today and our view of what they will need tomorrow. So according to Alex Karp, Palantir's customers are so incredibly dumb, so incredibly stupid that they just don't understand their business. They don't understand the direction that they are heading in. They don't understand the direction they should be in, or maybe, what tomorrow is going to bring to their business. No, only Palantir really knows. And there is a tension between Palantir really knowing and all these dumb customers having no idea, because our organizational and operational culture remains one of the most differentiated and unique among technology companies in the world today. Now, I do appreciate that Palantir have built some incredibly good software, extremely good software that many government organizations in particular and the military find really useful. But the incessant patting yourself on the back, the non-stop praising how awesome you are and how bad everybody else is, how everyone else sucks, is maybe not the best way to present a growth company that is yet to show it can turn a GAAP profit. Together with a sales pitch of a quarterly earnings call that was an absolute disaster that caused a complete destruction of the share price, it really does some major questions for investors. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it, and as always, I'll see you guys later.